Welcome everyone to today's seminar. My name is Ciamac Moallemi. I'm a professor at Columbia Business School, and I will be the host for today. Before we get started, I just want to set the ground rules for the format. If you have questions during the talk, please enter them in the Q&A. I will monitor those questions, and I will ask Mallesh in real time as they are appropriate. But as we all know, presentations are much better with lively discussion. So I would highly encourage you to submit questions during the talk. In addition, at the end of the talk, we will have a Q&A period. With that said, I am delighted to introduce our speaker today. And that is Mallesh Pai. He is the Lay Family Associate Professor in the Department of Economics at Rice University and a CEPR Research Fellow. His research interests include mechanism design and auction theory, and their applications to the design of blockchain and decentralized finance protocols. Prior to joining Rice, Mallesh was the Janice and Julian Burrs Assistant Professor of the Social Sciences in the Department of Economics at the University of Pennsylvania, and he earned his PhD in Managerial Economics and Strategy from the Kellogg School of Management at Northwestern University. Today, Mallesh is going to talk about the microstructure of Ethereum block production, and with that, I will turn the floor over to Mallesh. Thank you.
Thank you, Ciamac, for that introduction. And yes, I just wanted to second the spirit that, yeah, I really do appreciate questions. If something's not clear, please stop me. My dad joke on this is that, this is the opposite of the New York subway. If you don't see something, say something. With that introduction, let me just launch into my talk. Let me share my screen. I hope it's gone off in something. Start. All right. Sorry. All right. So this is my talk. Like Ciamac said, I'm at Rice University. I also spent some time working at the Special Mechanisms Group, which is a division of Consensus. This work is joint with two of my colleagues at SMG, Devas Gupta and Max Resnick, and also a colleague at Rice. In particular, I'm going to be giving you a talk based on three papers. One with Devas and Max on the effects of private order flow on proposer builder separation, a paper with Max on the structural advantages for integrated builders, and an in preparation work with all four of us trying to do some structural empirical auctions. The first two papers are available on archive. I hope the third one will be ready shortly. And standard legal disclaimer, the contents of this work don't reflect the opinions of our employers or constitute investment advice, legal advice, life advice, any of that. All right, so what's this talk about and why am I trying to give it? Ethereum is at present the second largest blockchain by market capitalization. It's a large blockchain, over $300 billion of market cap. And it is maybe by some metrics a very popular blockchain, not just as a store of value, but also for doing stuff in terms of decentralized applications, decentralized finance that I know a lot of you, I've seen a lot of you in this audience are working on. As academics, we've, economists, finance professors, and so on, we've fruitfully studied blockchains using our tools. And this is just sort of a random selection of papers that I've been reading. We've contributed to thinking about the economics of consensus. We've had a lot of thoughts using our tools from mechanism design to think about the design of transaction fees. And we've been studying the activity on the chain. So things like how should you design a decentralized exchange? What, market for NFTs, things like that. The thing is, we are sort of separating these two things. So either we go down, drill down and study the economics of consensus, or we sort of abstract away from that when we think about the operations of something like a decentralized exchange. And the point of departure of this talk is that maybe while we do like to isolate stuff as academics and drill down and study it, the interaction between these two things may actually be a fruitful field of study. So in particular, when we think about traditional institutions, traditional financial exchanges, for example, those institutions serve transactions in a first come, first serve basis. Here, transactions are not processed on a first-come, first-served basis. As several of you are probably aware, a blockchain proceeds in blocks. And there is an announcer for the block, and that block announcer has a lot of latitude to select what transactions from the universe of available transactions actually get included and processed. These block producers have their own incentives. And the incentives of these block producers on chains such as Ethereum will interact with the activities on the chain in ways that I'm going to try and elucidate over the next hour or so. So using these incentives, understanding these incentives and interactions may help us better inform our study, inform how we say we should design DeFi protocols, how we think we should, what kind of policy advice we give. But as I'll try and convince you, may also be just of independent interest for us as economists as a different place to use our tools. So that's sort of the broad level introduction. What's the summary of what I'm going to tell you in this paper? I'm going to try and spend a lot of time just doing sort of an institutional review. So describe how blocks get produced in Ethereum, and in particular, describe an auction that is incredibly large and incredibly popular. So this is an auction that has been happening for about 1.5 years now. Its run rate, its revenues annually are of the order of $1 billion. And to my sort of knowledge, this has been relatively understudied within the community. I'm going to describe the structure of this auction and try and convince you that there are some interesting sort of heterogeneities in terms of who is bidding in this auction and how. And then I'm going to present some empirical results from the data on these auctions and use that to study things of interest in terms of outcomes, in terms of counterfactuals, and so on. So that's a high-level summary. Unless there are questions, I'm going to just carry on. So here's sort of, bog standard. Here's the way we would classically model a blockchain, right? We basically say there are 3 kinds of active parties. There are users, and users are there just to do stuff. They generate transactions. These are signed, valid transactions. These could be token transfers. So I send some Ethereum or some USDC to Ciamac. Or these could be DeFi transactions. This could be me minting an NFT. This could be me swapping my USDC into ETH. This could be decentralized lending. All sorts of stuff like that is possible, especially on a general purpose blockchain like Ethereum. Just because I sign a transaction, like I said earlier, doesn't automatically mean that it gets processed. These valid transactions are not immediately processed. They just put out there. In particular, they live in a public sort of, let's just call it a repository called a mempool. And they're available to be included, but they're not immediately included. How are they included? Well, there are these people, we call them miners or proposers, and they're going to compile from the set of available transactions, they're going to compile valid blocks. There are a whole bunch of rules about block validity those details, I'll tell you the ones that are relevant as we go along. But at any single point in time, there's a single miner or proposer who is in charge of announcing the next block. That process could be proof of work, where you have to solve a cryptographic puzzle for the right to propose the next block. Or it could be proof of stake. Proof of stake is where each of the miners or each of the proposers has a bunch of the underlying tokens staked, and then they get randomly selected based on how the fraction of the tokens that they have staked vis-a-vis the total amount of tokens staked. The selected miner or proposer is going to determine the contents of the next block, and then validators, who might be the same people as miners or proposers, but the ones who are not announcing the next block, have to track the announced block and contribute to consensus so that we get this decentralized consensus on what was the next block and what happened in that block. So that's sort of our classical model of a blockchain. If you will, here's like just a simple schematic picture. Slots are time slots. After every time slot, a new block gets announced. And for example, here, my simple little schematic has a selected proposer, proposer 4, who is going ahead and announcing block 4 for us. Now, how is this proposer going to work now? A simplistic model might be that there's this mempool. So there's a bunch of transactions 1, 2, 3, and 4 sitting inside the mempool. And maybe transaction 1 is invalid or doesn't pay enough currently. Transaction 2 and transaction 3 do, so the proposer goes ahead and dumps these into the block that they're going to announce. The block is now full. There's not enough space to include transaction 4. So a vanilla block building process might do something like that. Just from the set of transactions in the order they arrive, dump them in to the block until the block can no longer hold any transactions, and go ahead and announce that block. Now, an important part of this is that there is nothing forcing you to do vanilla block building under Ethereum. You are the sole arbiter of context of the block. While I said there's this public repository called the mempool, that's not real in the sense that there is no consensus about what transactions are available, what order they arrived in. All of that is outside the scope of the consensus. So if you are told that you're in charge, if Proposer 4 is told that Proposer 4 is in charge of announcing the next block, for that period, they're a temporary monopolist. They can do anything they want in terms of the block, and they have a whole bunch potentially of value from being this temporary monopolist. We know that monopolies have value, and here the value is that you have, if you are the proposer of block 4, you get to decide what goes in. Anything that doesn't go in has to wait till at least block 5 or later. What are examples of this value? Well, one, if there are particularly time-sensitive or priority-sensitive transactions, so for instance, someone wants to do an arbitrage transaction or someone wants to do a liquidation, they may be willing to pay more for priority. Conversely, agents may be willing to pay for censorship. So instead of Ciamac being willing to pay for a transaction, I may be willing to pay more to have Ciamac's transaction not included. People, there might be, for example, a last look option. So I, as a block producer, there's nothing constraining me to just using transactions in the mempool. I can look at the transactions in the mempool, look at the state of the chain, and decide to insert some of my own transactions that I see as profitable. And there's a whole bunch of possibly other stuff. All of this combined gives additional value to being that monopolist for that one block. So here's a slightly updated picture of what might be a fancier block. Again, the transactions on the left are transactions that arrived in the order they arrived, but the block that you announce could be something different. You could choose to say, okay, it's somehow profitable for me to include transaction 3 above transaction 2. So I'm going to go ahead and do that. But additionally, I could generate a whole new transaction, transaction 5, and say transaction 5 gets to go first in my block. And if it's your turn to do that announcement, no one is stopping you. All right.
Mallesh, just a quick question from Fahad. Can you clarify the mechanics of censorship? In particular, with the example with my transaction, if I sign a transaction and give you a valid transaction, how are you able to keep that off of the blockchain?
Well, so there are two versions of this. One is if I was the block builder, for example. So if I happen to win the right to propose the next block, I could go ahead and just say, okay, I don't want any transaction from Ciamac's address in my block. That's an easy version. If I wasn't in charge of proposing the block, but I was, for example, aware of who the next proposer was, I could write a side contract with them. I could tell them, I will pay you $10 to leave Ciamac's transaction off the table.
Got it. But just to clarify, this is like a temporary censorship, right? You censor me for one block or however many blocks you're willing to sort of bribe the proposers.
So yes, so it is temporary. And again, the cost to censor is somewhat related to then how do you respond to that censorship. Now the censorship, I mean, some of the censorship, by the way, is also regulatory. So even though the chain per se is neutral, currently OFAC puts a lot of pressure on various entities within the system to not announce blocks that contain any transactions from designated sort of sanctioned entities. So currently transactions, for example, with addresses that have been identified as belonging to Iran, North Korea, and so on, have substantially more difficulty making on chain because the builders, the block builders who are in charge of producing these blocks are just, the ones who have any domicile or any any sort of exposure to US regulation or related regulation, choose not to include those transactions. So there are various modes for censorship. I'm going to talk about one more in a second. So, but hopefully that clears it up a little bit.
I think that's clear. I think just one other point is that I think some of the mechanisms, for example, the OFAC, you are anticipating the possibility of off-chain agreements.
Yes,
right?
Exactly. Exactly. So censorship, for example, a lot of these mechanisms might be some of the value for what I call maximal extractable value might be realized through off-chain agreements. So these are not things that are directly part of the chain, but somebody can, but as a proposer, you can write side contracts and honor them off-chain and get paid for them.
Thank you.
All right. So now the sort of, excuse me. The point of departure of this talk is that circa fall 22, so in particular in September 2022, there were two major changes to how Ethereum operates. So the first was they moved from being a proof of work chain. So Bitcoin, for example, is still a proof of work chain where miners solve a cryptographic puzzle, and they basically construct a block and then solve a tricky cryptographic puzzle in order to complete the block. And what proof of work does is that because it's proof of work, you don't know a priori who is going to announce the next block. It's just the first person to complete a block with a valid solution to that cryptographic puzzle. They moved from that to being a proof of stake chain. And a proof of stake chain means anyone can stake. Ethereum's parameters are that you have to stake 32 ETH, which at current market prices is a little over 100,000 US dollars. Once you stake this, you lock it up and you become a validator. And then from the set of people who have staked ETH and become a validator, every few periods, Ethereum draws the set of the next, draws randomly and announces some of these validators are in charge of announcing the next block and the block after and so on and so forth. Excuse me. And the main feature of this, or the part that I want to stress about this, is that in a proof of stake chain, the proposer of the next block is now known a priori. Unlike proof of work, where I would be racing to solve that cryptographic puzzle, now under proof of stake, I know that 3 blocks from now, it's going to be my turn to propose a block. Okay. The second thing that was the second major change to how Ethereum operates was that it implemented something called proposer-builder separation, which is now sort of popular in many proof of stake chains. And what is proposer-builder separation? Proposer-builder separation is basically providing, currently by a sort of semi-off-chain methodology, but essentially it's Ethereum or things that's affiliated with Ethereum providing infrastructure for the proposer to outsource the actual building of their block. So in particular, going back to our simple model where there were 3 parties, users, miners or validators, and miners or proposers and validators. Now there's a 4th class of active parties in our little model, which is that there are people who are called builders whose job in life is to build blocks. Okay. Now, why would you do this? Why you do this is, firstly, this business of extracting value from a block is hard, right? So just from like the set of available transactions, excuse me, figuring out which set of transactions is the most profitable and is feasible and so on and so forth is a computationally hard problem. Formally, in the language of computer science, it's a knapsack problem or it's NP complete, but you can just think, you have 200 transactions, maybe there's 200 transactions or space for roughly 200 transactions in a block. There are 1,000 maybe available transactions, just the combinatorics of running through that and solving it is mind-boggling. On top of that, you have all the additional rights that you are granted or all the additional potential extractable value, which makes being a proposer valuable, what we call MEV. Now, this does make it valuable, but finding or executing these opportunities is highly non-trivial. So identifying that, okay, I could make a lot of money or I could make some profit if I inserted this transaction in the middle of these 2 transactions, or if I could create my own additional transaction between these 2 transactions, I could make some money. These are all non-trivial things that maybe proposers do not have the capabilities, or several of them don't do. In particular, there was a concern that large proposers, so people who have staked many multiples of 32 ETH, might also be just well-capitalized, sophisticated players who would be better at these activities. And there was a concern that then, you'd have this sort of higher returns for large proposers, but with higher returns for large proposers, they'd outstay, like their rate of stake growth would outpace small proposers, and eventually you'd get centralization where just a few proposers own most of the stake. So there was this idea that let's level the playing field by creating this class of builders. And in particular, what was created and what is going to be the topic of most of what I want to introduce you to today is this out-of-protocol system called MEV-Boost. So what is MEV-Boost? MEV-Boost is an opt-in system that any proposer can use if it wants to. And roughly speaking, the idea is, that it's your turn to to announce the next slot. Whenever you want to, you can just call the auction. There are bidders bidding. The builders are bidding in an open outcry English auction. It's obviously electronic because there are 12-second slot times, so you have only 12 seconds. But builders are bidding. At any point, you can just call the MEV-Boost system. For the purposes of today's talk, just think of it as a single monolithic system and just say, okay, what's the current top bid? Give it to me, and you can announce that block. You get the winning bid as the proposer, and conversely, the winning builder's block is announced as the next block. Okay, just as an image, here is a sample. Oh, I am so sorry about this. As a sample, here is the next. Here is a particular block, which is 17195,495. The sort of left to right axis is time into the slot. The vertical axis is the amount that these builders were willing to bid for the right to win the block. So the right to have their preferred ordering or their additional transactions included. The colors are the different builders. And I mean, this is a cherry picked block in the sense that note that the winning bid went up to over 25 ETH, which is well over $75,000 at current prices. So this is just a sample auction. And I hope that design makes sense. So this is the MEV-Boost protocol is the one that is currently in use. It is incredibly popular. So just to be clear, the system started in fall 2022. And as you can see, since fall 2022, it very quickly became the dominant way to produce blocks and has stayed the dominant way to produce blocks. Over 90% of blocks are generated using MEV-Boost.
So just to clarify on that point, Mallesh, this is entirely out of protocol, and this is sort of an organic equilibrium that people have converged on using this. In particular, there's nothing in Ethereum that would force this right now.
So there is nothing in Ethereum currently that would force you to use this. This was I would hesitate to call this a fully organic equilibrium in the sense that there was a lot of backing to have a system like this. And there is a roadmap to take this out of protocol system and put it into as part of the protocol, but that, there are some technical challenges to do that. So to hurry along the process, because they were very worried about these heterogeneities between what large proposers could do and what small proposers could do, as a community, there was a settlement on a compromise, which was have this out of protocol auction. But I believe many people view this as a step to an end state where an auction or some version of this market design will be subsumed into the protocol. Okay.
Thanks.
So this is 90% of the slots. This is, like I said earlier, this is an incredibly popular auction. So just the right to propose your block, the right to have your ordering or your included transactions as part of the transactions is about 400, has made since inception about 400,000 ETH to date, which at current prices is somewhere between 1.3 and 1.4 billion dollars. I want to stress a couple of things. So one, note that the Ethereum chain additionally charges the way it does transaction fees. It does not it the block producer does not get all the transaction fees as they do currently in Bitcoin. So there is something called a base fee. That base fee does not accrue to the proposer. It simply is simply burnt. So that amount of if you spend that amount of money is just destroyed, taken out of circulation. Those base fees are more substantial still. They're about twice the amount. This 1.3 billion is just the economic value that people have been willing to pay to have their preferred ordering as the ordering that is, or their preferred transactions be the transactions that are processed in the next block. Side note, going back to Fahad's censorship question, this sets up an additional vector for censorship in the sense that I can just buy the next block and have my preferred transactions included and other preferred transactions not included. I don't have to side contract with the proposer. As long as the proposer is using this auction, I just have to win the auction. Okay, and people have done that. If you think, depending on how you feel about 1.4 billion, it's a fairly stable amount also per block. So the per block median is somewhere between, is normally fairly stable around 0.05 ETH. There is a fair bit of variance around that. So like I showed you, that particular block had 25 ETH as the winning bid. There are several blocks in any given data set that are worth more than one, which is like $3,500, or 10 ETH, which is $35,000. So there is a lot of variance, and there is a lot of variation in how much these blocks are worth. And that led us to start thinking, well, why is there variation in how much blocks are worth? Is it solely driven by the amount of priority fees, for example, that people are willing to pay for their blocks? All right. Now, here's a different fact about the market, which is who are these builders and what kind of market shares are they achieving? And one of the interesting things is that currently, as of the last 15 days, for example, the market shares are incredibly concentrated. So the top three builders achieve about, or produce about 85, win about 85% of the auctions. So these are the builders that are known as Beaverbuild, rsync, and Titan. And there's a small competitive fringe, but that small competitive fringe is only winning about 15% of the auctions right now. I want to just take you to watch the sort of evolution of these market shares, because it's kind of interesting. This is sort of September 22. As you can see, initially there was a large competitive fringe of builders winning about 50% of the blocks. But if you look at the cumulative lot, at some point, Beaver started to win a lot of blocks, maybe around December, October. And other builders started joining and winning a large fraction of the blocks. Manta and rsync started catching up. Manta, for reasons we'll talk about in a second, shut down and no longer produced blocks, so it started to disappear. But rsync and Beaver continued on their march to dominance. This data set, this particular animation only goes through June 2023, but as you can see, that process has continued. Titan is a relatively new entrant. So this is what's going on. Now, why am I focusing on Beaverbuild and rsync? These two builders, I will argue, are qualitatively different than the other builders in this market. So Titan and a lot of the other builders are builders that are simply trying to solve that computational packing problem. People send them stuff, they receive it, they try and assemble it into the most profitable block they can. rsync and Beaver are builders that I will try to convince you. I mean, they are publicly known to be owned by a trading firm or a market maker. I'll try and show you evidence of that from the chain and from transactions. I'm going to call these people integrated builders and call the others neutral builders. And the next question you might have is, well, why would a trading firm want to own a builder? Well, the answer is fairly simple. If you're a trading firm, you get the right, and you own the builder, you get the right to announce the next set of transactions. You can use that next set of transactions fairly profitably. So here's the same block that we saw the auction bar before. On the right are the bids. What I want you to look at is actually the panel on the left. So on the left, what we've done is we've lined up against the bid times the price of the Binance order book for ETH USDC. So how much is the current market price of Ethereum expressed in US dollars? The purple line, this one, is the midpoint at the start of the last, or when the last block was announced. Over time, of course, the Binance price moves, but this block in particular was very volatile. So the price of Ethereum during that block moved by nearly $50, and that you can see as the movement in the yellow line. The yellow is the mid over time. Why is this important? Well, remember, Binance is a centralized exchange. So the price in Binance evolves in real time. Ethereum is a blockchain. Blockchains proceed in blocks. In particular, on Ethereum, blocks proceed every 12 seconds. That means that on the chain, between the announcement of the last block on Ethereum and the announcement of the next block, nothing happens. There's no activity, no updating from what's happening in the outside world. The price of Ethereum has moved by $50 on Binance, but on chain, on Ethereum, Uniswap or any other decentralized exchange has no clue about this, or at least to a first order, you can imagine that that they have no way, because nothing happens between blocks on chain. So for a trading firm, for example, here is an easy thing to do. Watch the price in Binance. If the price of Ethereum goes up between the two blocks on Binance, you can buy at the stale price on Ethereum, on the chain. If the price goes down, you can sell into the stale price on the chain. And that's exactly what happened. You can see as the price of the mid on Binance started to move, when it moved a lot, suddenly you see the bid start to jump up. This is not just a theory. You can also verify this from what the winning block. If you look at it, the first 37 transactions, I only have 12 in this screenshot, but the first 37 transactions are all transactions conducted by this particular address, 0xA69. And 0xA69 here is, for example, the sample transaction. This is the first transaction on the chain, so it's the biggest. It's a transaction. Remember, the price moved up. So what's it doing? It's trading with the Uniswap pool, buying 2,000 Ether at a price of 4 million. It's buying cheaper from Uniswap because Uniswap has not updated to the new price yet. The next 36 transactions were just sequentially going ahead and doing similar ARBs on other pools with other tokens and stuff like that. But 37 transactions. Here is other evidence. So here is the particular bot. So this was your 0xA69 bot. What we are tracking here is for different things that have been identified by us as trading bots, what builders' blocks do they appear on and how often? You can see that some bots, for example, appear with some frequency across all builders, but there are bots that only appear on some fixed builders. And so that gave us this idea that there are builders who are integrated into particular bots. All right. So what's our first set of results? Well, the first set of results.
Mallesh, excuse me.
Yeah.
Maybe I can ask a couple of questions before you jump
Sure.
into your results from the audience.
Yep. Yeah, absolutely.
So first question from Fahad. Do you have any sense of how competitive the builder market is? In particular, like a lot of these arbitrage profits are difficult to sort of quantify. But what's your sense of how much of this MEV is kept by the builders versus distributed to the proposers?
That's a great question. We've tried. I mean, part of our problem is we can only. So there's two sides to this. One, we observe only two things on chain. We observe their bids and we observe the trading activity that they do on chain. So our best estimate from talking to people is that the auction there are only two current competitive integrated builders in the market. So it's not that like they're not essentially competing away all the ARB profits into the auction. Rule of thumb, so this is not a formal result. Our understanding is that the auction revenues are about 30% of 30, maybe 30% of the total ARB value. But note that they also have a second leg that they need to clear, which is they also then need to unload or maybe unwind some of that inventory into the centralized exchange to complete that ARB, or they have to carry that inventory and carry the risk. And that part we have just no visibility into. So our best guess is that this is not competitive to the point where the entire ARB profit is just going into the auction.
Got it. So it's way less competitive, for example, than let's say the market for atomic arbitrage, where you can see that like 95% of it of the value gets paid to.
Exactly.
Okay.
We believe it's substantially less. Yes.
The next question is from Thomas Rivera. Thomas asks if the auctions were to move on chain, in other words, if PBS were to be enshrined, would the auction actually occur on chain if it's in the protocol, or would it be off chain? And if it's the latter, if the auction is still off chain, even though it's somehow enshrined in the protocol, what would be the difference between an enshrined version of PBS in protocol and the current MEV boost system?
Yeah, so so those are great questions, and they're slightly outside, they're slightly above my pay grade, but there are 4 or 5 different designs out there. Some versions envisage using like a faster tick chain that only exists to conduct the auction. So that would move the entire auction on chain. Some versions use a different market design altogether. For example, I sell my right to, instead of selling the block in real time, I instead pre-sell my right like 5 blocks early. And because I've not realized a lot of the stuff, I can do the pre-selling because we know who the proposer for the next 32 blocks is going to be at any or at most 32 blocks, but we often know the selection is made sort of 32 blocks at a time, who's going to be the next, who are going to be the proposers for the next 32 blocks. So you can do these auction sales ex ante, and you then can buy yourself a little more time even to do it on the current chain. So there are various proposals. Each of them has issues. What are the differences? So one of the big, what is the off protocol part doing? The off protocol part is solving sort of a fair exchange problem. So what is the fair exchange problem? The moment I know the builder's sequencing of transactions, I can just, or what transactions the builder plans to do, there is nothing stopping me from replicating that. So the builder doesn't want to give the block payload over until the proposer has signed the transaction. Conversely, the proposer doesn't want to sign something without knowing what's in it. Like so what we have is sort of this intermediary, because they don't want to do something illegal. They don't want to sign an invalid block. Those are things that get them into trouble with the protocol. So what we have are these out of protocol parties called relays that are essentially intermediaries that solve this two-sided commitment, two-sided holdup problem. And part of moving it onto chain would be, can we remove the need? And there are some designs that want to do that and some designs that don't. Can we remove the need for these out of protocol third parties that just solve the two-sided holdup problem?
Got it. In particular, those third parties have to be trusted, and it would be better not to trust anyone.
Exactly. So we like less trust. In the context of this community, we like fewer trust assumptions rather than more.
Thank you.
Okay. So here's sort of the results from the first paper, which is we identified these integrated builders using the methods we told you above. And what we did was we just collected the Binance price data during each block period. And we measured like what was the realized block change, during realized price change during the last 12 seconds. And saw how that price change affected the probability of an integrated builder winning the block. So, or the people we identify as integrated builders. So here are the logistic regression results. To interpret these results, here's the implication, which is if the price change was 0%, so if there was totally flat Binance, the price on Binance was totally flat, just didn't move much in the last 12 seconds, then the probability that an integrated builder wins the slot is 0.3. If you go up to 1%, then the probability that an integrated builder wins the block goes all the way up to 0.775. So integrated builders win the block more often when there's a lot of price movement, because that's when their strategies, when it is most valuable for them to win the block, because they can put their bots' transactions and close those arbs between DeFi protocols and the centralized exchange. You can do this builder by builder in a multinomial logit, and indeed you see that the things that we identify as high frequency trading firms, Beaver, Manta, which shut shop and went away for regulatory reasons, rsync. These are positive. On the other hand, neutral builders or non-integrated builders, Flashbots, Builder 69, have negative coefficients. Okay. Now, in the interest of time, let me skip ahead. But what we go ahead and do in the rest of this paper is basically identify sort of in a world where you've got your own transactions, which is the top of block value, and then also you have the ability to buy other transactions, for example, from an order flow auction, which is what several firms are moving to. What is the effect? The idea in the model and the paper, which is available for you to read, so I'll jump over it, is basically that if a person has an advantage on one part of the activity, which is the top of block, then their value to winning auctions in the other thing is sort of embellished, because they have sort of a larger bundle value, and they expect to be able to win the overall auction more often. So we essentially show that there's a centralization effect where these guys win, even small advantages in top of block extraction ability leads to large jumps in the probability of being able to win overall. What's the second paper about? The second paper was about understanding the latency advantages. So the main point of this was that we've looked at the advantages in terms of winning other transactions or winning other order flow auctions. But there's also advantages from the fact that you have an integrated builder. You have a builder that integrates a trading bot or trading bots and a builder. And as a result, you sort of know what is the value of the ARB, whereas a non-integrated builder might still have trading bots submitting to them, but they are bidding into but they are basically getting those transactions submitted to them as bids. They have to put them together and then submit into the main MEV boost auction. So they suffer a double marginalization problem in the language of economics. Or put differently, the integrated firm is basically bidding in the English auction in a second price auction. From the perspective of a non-integrated trading shop that is bidding that is trying to get its ARBs onto the chain via a neutral builder, they're bidding in a first price or pay your bid auction. I'll try and jump over this because I am running short of time. I do want to show you one last visualization, which is hopefully you could hear that sound. So what was the point of this visualization? What we're trying to show you is the times at which neutral builders bid versus the times at which HFT builders bid. We're using a xylophone for neutral builders. We're using piano for HFT builders, and you can sort of see, and then the bid is sort of deciding the note. So you can just auditorily tell how the bidding changes over time. Anyway, so in this paper, we sort of look at these latency advantages. In particular, many of you are presumably familiar with, or the non-academics in this audience are presumably familiar with like Michael Lewis's book, Flash Boys, on latency advantages in traditional financial exchanges. The academics are presumably familiar with both that and maybe like a paper like Budish, Crampton, and Shim that tries to identify the value of latency advantages in a traditional financial exchange. In this paper, we try to look at how those sort of things, those latency advantages still translate into advantages even in a 12-second auction. Because you can bid later, you have more information at the time you bid. So even though the blockchain only proceeds 12 seconds at a time, being faster still gives you a ton of value. All right. Let me jump to my last topic, which is structural estimation of MEV boost auctions. So hopefully the previous analysis has convinced you that we have an auction with two kinds of bidders. What we can do is we can use techniques from the literature on structural empirical I/O to study this auction. In particular, there's a rich literature on auction empirics that tells us how to estimate primitives, for example, the distribution of buyer values from observed bids. And we can use these identified primitives to study counterfactuals of interest in the community. So for example, if, an example of a counterfactual would be if the ecosystem wants to foster entry, should it try and convince a neutral builder to enter, or should it try and convince an HFT builder to enter? Other things you can do is once you have the distribution of values, you can do counterfactuals in terms of auction format, which is, for example, we currently use an English auction. Should we use for example, a first price sealed bid auction instead? Okay. It's also, I think, just academically of interest in the sense that we have a lot of very successful, very important papers studying auctions, taking auction theory to data. And here, the MEV boost auction is providing a rich, well-designed auction or rich, sort of well-structured auction that is a substantially larger data set to use our models on or use our techniques on than existing empirical auction papers. So I selected a smattering from people who I look up to in the profession and sort of the number of data points that they had at the time they did their estimation. And here is, 2024 is a hopeful year by which we get this paper out. But note that we have already, just in the year and a half, well over 1 million auctions. So here's sort of the data set that we did. We collected all the bids for roughly 200,000 blocks. That's all we limited ourselves to correctly. These are blocks that are basically from the period of like early December, basically a month of data from over December 2023. And we tagged these bids by builder. So we figured out who the builder is that corresponded to each of these bids and categorized them into whether these builders were integrated or non-integrated. For each block, we also constructed a bunch of exogenous variables. For the purposes of today's exercise, which is super preliminary, we are just using 3 explanatory variables. One is the previous 12-second ETH/USDC absolute price movement. The other is the base fee that I tried to describe, which is the fee that Ethereum charges in that block. They have a dynamic fee with an adjustment mechanism. So this is the fee that Ethereum charges for a transaction to be included, and a constant. We can use potentially a whole bunch. We have access to a whole bunch of other exogenous variables. For example, the number of transactions in the mempool. We can use lag gas prices and block prices. We could get price movements for other popular tokens on Binance or on other exchanges. So those are our exogenous variables. And what we're going to do is we're going to take a standard assumption from empirical.
Mallesh, before you dive in,
yeah.
let me ask a clarifying question from Jingu He. If these bids are all off-chain, who is aggregating and managing the data?
Very good. So these bids are off-chain, but the auctions are conducted by those intermediate third parties that I described a little earlier that are called relays. And relays do have APIs from which you can collect the bid data. We have gotten it from them. Some of them are very willing to collaborate. And so we've basically managed to collect and aggregate. So there's a little bit of work that I'm not describing, which is we actually have like 5 major relays and maybe 9 or 10 relays overall. So we actually need to collect the bids at all of these relays, line them up into one auction, and then figure out when that auction finished and then what the bids were. So there's some cleaning work, but it's not it is collectible, and I'm happy to go into more details or chat more about that offline afterwards.
Thank you.
Okay. So what's our identifying assumption? Our identifying assumption is one that's been used a lot in empirical auction analysis, which is that while the highest bidder in the English auction is stopping somewhere before their value, stopping because they don't even know, because they don't need to be out, they don't need to outbid anyone. Here, we know that bidders will continue, for somebody who has been outbid, if they have a particular value, they can increase, and it's profitable for them to increase their value above the current highest bid, they will continue to do so. They have a weakly dominant strategy to do so. So the assumption that we're going to use is that bidders will continue to increase their bid unless the prevailing high bid is higher than their value. And an implication of that is that for bidders who are not the winning bidder, their bid reveals their true value. So in practice, what that means is what we're going to do is we're going to look at the second highest bid for each bidder type. So from the auction, we know the winner, but we're just going to use the second highest of each bidder type because we know that those two people were outbid. They chose not to increase their values. And from the fact that they chose not to increase their bids, that reveals to us that that must be their value. Okay, we're going to have a simple model today. The model in the paper will be slightly more embellished on this, but I just wanted to put the simple model up there, which was we're going to model a bidder's value as coming from two components. So as a function of your type and as a function of the exogenous x's that I described earlier, gas fees, Binance movement, and so on, you are going to get a common component. So if I'm rsync or if I'm Wintermute, if I'm rsync or if I'm Beaver, we both have the same exogenous, we both have the same common component CT. And then on top of that, each of us will receive a idiosyncratic shock, an epsilon, which is random and independent across all bidders. But the distribution of epsilon may depend again on the exogenous variable. So your value as a bidder depends on this common component that is just a function of the type and the x's, and an epsilon that is a function of whose distribution depends on the type and is independent across bidders. So we still have a private values auction. It's just the x's are shifting, sort of moving around the distribution as a function of the x's. Okay. Today we're going to do a simple specification. So the simple specification is CT is going to be just exponential of mu t, some unknown parameter, times x. Again, we can easily update this to include squared terms and so on, but at least for our current set, these additional squared terms don't seem to add any explanatory power. We're going to assume that epsilon IT is log normally distributed. And that's because in the data, we see that the bids are the closest sort of well-defined distribution that they seem to adhere to is log normally distributed. In particular, it's log normally distributed with mean 0 and variance sigma square, where sigma is again an exponential just to make sure that this is always positive because variances have to be positive. Okay, so what we want to learn are these parameters omega and mu. And we're going to use our identifying assumption. So how are we going to use our identifying assumption? Well, we know that because the second highest bid is equal to the second highest draw from NT, where NT is the number of bidders of that type, draws from that distribution, we have this moment condition, which is that the second highest order statistic from NT draws from the distribution conditional on the exogenous values. The expectation of the log must equal the log of this common component plus the expectation of the log of epsilon. The right-hand side now solely consists of the stuff that we don't know, and the left-hand side by our identifying assumption is observed in the data. So we can just set up a nonlinear least squares and find the best fit. Here's the best fit. So these are the these are the conditionals, these are the mu's and the sigmas that we identify. In particular, note, I mean, we'll interpret this in a second, but note that for integrated builders, the coefficient on the price change is higher than for non-integrated builders. So that's our best fit estimate. And that sort of is, at least reflects and is consistent with our previous result and reflects the theory that integrated builders are just more, their values are more sensitive to those underlying price changes because part of their business is these ARBs. So here's what that means, for example, for a sample block, for a particular sample block that I just randomly drew. In that block, the base fees were 30.2 GUE and the ETH-USDC made moved by 3 bips. The winning bid was 0.1068 ETH rsync. The second highest bid, which among integrated builders was 0.1038 ETH, and the second highest bid among non-integrated builders was 0.1002. Conditional on these X's and conditional on our parameter estimates, we believe that in such auctions, integrated builders have values distributed as 0.126 times log normal 0, with a standard deviation of 0.924. I forget if this was supposed to be standard deviation or variance, but please forgive me. And non-integrated builders have 0.118 times log normal with 0.995 standard deviation or variance. And this is sort of a general finding for the values of the X's that we see in the data. In general, integrated builders' value distribution has a higher mean and a lower variance than non-integrated builders for typical values of X. So more often than not, integrated builders are more tightly bunched together, but they're also on average willing to pay more, which is consistent with, of course, the fact that they're winning a lot of these auctions. Like I showed you in the data, they're winning more than half.
Malesh,
something.
a question before you continue. As you mentioned, there's more than one relay, and not necessarily all proposers are listening to all relays. So
That's
does
right.
all proposers don't see all the bids? Does that impact your results? Is a question from Fahad.
That's an excellent question. So currently what we're doing is the one thing we do know is we do know who won the auction. So we know that you're listening to some subset of the auctions that can. So for instance, imagine there was relay 1, 2, and 3, and only relay 2 and 3 contained the winning bid. Contained a bid corresponding to the block that turned out to win. Then we know that you as the proposer are not listening to relay 1. So currently what we're doing is we're just throwing out relay 1 for that particular auction and only using the relay 2 and 3 auctions as relevant for that auction. Going forward, we actually have, after presenting this in an industry venue last week, presenting an even more preliminary version, we did get offers to get a little more data to actually know who, for each proposer, which relays are they subscribed to, and so on. So while the empirics will also get a little more sophisticated as this paper marches to completion, we also believe we'll have slightly more refined data in the weeks to come.
Thank you.
So things you could do with this, I'm not going to present results because this was just too preliminary, but one straightforward thing is with the distribution, with the empirical distribution of X's in the data and the estimated coefficients, you can do counterfactuals on entry and see, for instance, is it worth it for you to start a integrated builder or a non-integrated builder, given some cost estimates of doing each. Note that integrated builders, because they have to do a trading wing, are substantially more capital intensive. So there's a question, you could ask and answer the question of how much more capital intensive do they have to be to dissuade entry. The one that we're most interested in is increasing validator, or not increasing validator revenue, is doing counterfactual market design. So we know this doesn't exactly fit the theorems that we have. So we know from Maskin and Riley, or most recently from Kierkegaard, that when you have heterogeneous bidders and their values are either shifted or stretched, one class of bidders has a value distribution that is either shifted upwards from the other class or stretched from the other class. then revenue equivalence no longer, well, revenue equivalence no longer holds in general, but Maskin, Riley, and Kierkegaard tell us that first price sealed bid auctions may have higher expected revenue than open English auctions. Here we have a setting where your value is shifted up, but also compressed. It's not because the variance is lower. So we are in the process of numerically estimating the counterfactual equilibrium under these distributions of values, but first price auctions to see whether there is a case for these relays switching, for example, to a first price auction instead of a second price auction. All right, so I'm almost out of time, or maybe I'm actually out of time. I apologize. So in summary, as academics, especially academic economists and finance people who were kind enough to invite me to this, we've used our tools to analyze a lot of stuff that happens on blockchains incredibly fruitfully, in my opinion. And I believe that understanding this microstructure sheds new light on these topics. That is, that we might want to take this particular microstructure and the incentives that it engenders into account, both when thinking about consensus layer and when thinking about DEX or DApp design. I know that within the community, people are actively thinking about the impacts of this microstructure, and it would be great for academics to join in and do that. And additionally, I think this data set just is a rich, fertile vein for economists to study, in the sense that how often do we have an unexplored billion-dollar auction with thousands or even millions of data points with which in which we can run amok, and in which data is relatively easy to get, relative to like needing to try and get something from like Amazon or Apple or Google or whatever, where it's much harder. And in particular, if you have ideas or if you want to chat more about our data or collaborate, we'd be speaking for myself and my co-authors, I believe we'd be very happy to chat more or just give you pointers on how to get there on your own. So that's my talk. I thought I'd summarize with this pet peeve I have for the way we do market design in general, which is whenever things don't look right, we stick another option in and hope everything works out. But I think there's a lot of scope here to do informed market microstructure design and informed market microstructure analysis. So with that, I'll conclude. Thank you.
Thank you, Mallesh. That's great. Really appreciated the talk. We'll do the Q&A right now. I have a couple of questions queued up already, but I do want to encourage the attendees. If you have a question that you have not typed in yet, please feel free to raise your hand, and we will you can answer the question in a voice. So first question coming from Fahad is that from a theoretical perspective, if we're looking at two different integrated builders and they're running basically similar strategies, for example, DEX-SEX arbitrage, why should we expect them to have different valuations? Is it because of heterogeneous trading costs, or is it because of some other reason?
So I think, so part of it is, I think that sex-tex arbitrage, I mean, it makes it sound like they're conducting the CX side of that arb, but they're not. That, I mean, the volumes on Binance simply do not line up to them. It's not they're not doing an atomic arbitrage where they're buying on Uniswap and immediately selling that onto the Binance. Even the volumes on Binance, which is by far the largest exchange on the centralized crypto exchange on the planet, do not support that. So what they're really doing is they're using the price signal that they're getting from Binance or from other sources to make an informed judgment on where the prices will go, and they're doing some inventory management. So there are differences in their, how they're aggregating all the signals that they're seeing from Binance prices, Kraken prices, Coinbase prices, other prices, maybe the futures prices, and what they're, how they're doing inventory management. I do not think they close that arb even over. Like, I don't think they immediately try and liquidate, atomically do that arb. So they're just using it as an informed trading strategy because the markouts are really good for doing that, and how the differences in their models and the amount of inventory risk they're willing to take on probably sort of dictate the differences in their valuation. for that
Got it.
strategy.
Could another reason be differences in private order flow that these builders have?
So that's yeah. So I glossed over that a little bit. The first paper was trying to get into the private order flow parts, and that is very much a difference. So remember, the part of the block is the SexDex arb. Part of the block is stuff that you're picking up from the mempool. A third part that's an increasingly important part is private order flow, which is order flow that did not hit the public mempool and was directly sent to builders instead. And a lot of people do this. For instance, some other trading bots or searcher bots do this in order to avoid their strategy being forecast and in order to get some privacy for the ARB or whatever that they're trying to do. A lot of privacy-minded people want to do this because they don't want to broadcast their transaction. And yeah, so I think for that's another source of difference. If you have order flow that is private and exclusive to you, or if you've managed to sign a deal for private order flow that is private and exclusive to you, that's a huge source of difference. We're trying to take blocks and decompose them into which parts came from the public mempool and which parts came via private order flow, and which parts came from your internal trading bots. But that's, as you can imagine, intensive exercise. So we don't have much to report.
I think for this audience, it's also interesting to observe that it's basically very similar to the payment for order flow structure that you see in traditional markets like U.S. equities. Very similar things
Yes.
are going on in this
So
space.
and I just and just to so there are two sorts of things, right? So one is you are definitely seeing some sources of order flow do something like, for instance, the Robinhood Citadel. You pay me, X dollars, and I will exclusively send you my order flow for the next year. You're also seeing other market designs. So in particular, like something like SEC Order 615, which was like, oh, you should be selling your order flow. You should be selling it transaction by transaction. You're also seeing that sort of private order flow market where there is, instead of stuff going into the public mempool, it's auctioned off transaction by transaction or something like that. Things like that has started to organically emerge here. So currently, there are order flow auctions. The big ones are MEV Blocker and MEV Share, and the transactions are not publicly available, but builders can bid on them, and if they win them, they can include that transaction in the block. So there are also other market designs other than the ones we see in, or other than the ones that I know of that we currently see in TradFi.
Thanks, Mallesh. Question from Michelle Fabi. What are the first order sources of latency in the context of these auctions?
So first order sources of latency, I think different builders have different speeds at being able to construct and simulate blocks. Remember, we're talking about a 12-second auction, and most of the activity is in the last 2 seconds. So if it takes you, for example, every time you have to add a bunch of transactions to update your block and resimulate it and come up with a fresh bid, if it takes you like a quarter of a second versus 0.1 second, that's a huge amount of time. Networking latency is another one, because there's really most of that 12 seconds is not the relevant part of the activity. Really, as I showed you with those bids, a lot of auctions get decided in the last 2 seconds. And in 2 seconds, I'd say those are the two major sources, which is networking and block simulation. And differences among builders in terms of their technological capabilities. So some builders, for example, have an advantage because they move to faster languages that can, resimulate blocks faster, try more combinations, and so on. And like languages that are closer to compiled code rather than assembled code, that gives them a major advantage.
Thank you. Another question from Jiangxi Liu. Could you share a copy of your paper and slides after the talk?
I'd be very happy to. I will. The two of the papers are up on our archive, and I'd be very happy to share a copy of my slides. I'll send the links. I guess to Fahad. I don't know if you want to just post it on the website, or I don't know what the best way. And anyone can. I just type my email address into the chat, and I'd be very happy to just respond to any further questions.
Wonderful. Are there any other questions? Okay, with that, before everybody leaves, I do want to take a moment and advertise the just recently announced CBER summer school, which will be this June, hosted at Columbia University by the Center for Digital Finance and Technologies. Please be aware of this. I did paste the link in the chat as well, and hopefully you all can participate. And let me take a final moment again to thank Mallesh for a fascinating presentation. You've given us a lot to think about today. Thank you, Mallesh. All right,
Thank you
goodbye,
for
everyone.
having me. Good night. Goodbye, everyone. Thank you.